Okay, hello everyone. Nice to have you joining us today. My name is Mark Maimon. I'm a Senior Vice President with NJ Lenders, and I'm really excited to have you guys here today. We've got a really nice, sizable group, which is great, and really looking forward to talking through this important topic. So we'd love to hear, we have people joining from all across the country. We'd love to hear where you're joining from. And so we'd love for you to post in the chat. And also, if you have any questions that come up during the session, please post those in the chat as well. And we'll be getting to them in the Q&A session at the end. So appreciate you guys engaging and asking any questions that come up. This is actually our very first session of what we call the Financial Wellness Forum. So for me personally, one of the biggest problems I see talking to clients every day and talking to agents and people in the financial community is that there's just a real lack of good financial advice. And so we decided to do something about it. So our goal is to bring topics related to personal finance, real estate, and other related topics to our community, whether it be agents, past clients, future clients, clients of agents and financial advisors, but just to raise the bar with financial literacy, which we think is really lacking for most people. And we found that people that need financial advice the most are the ones that typically aren't getting professional advice. So our goal is to help bring some of these concepts to you, and eventually in future sessions, we'll be highlighting different people from our community who are experts on different topics related to, again, personal finance, maybe finance issues during a divorce, for example, or planning for an expanding family or anything like that, retirement, that are non-mortgage related topics, but just ones that we feel are good to know about so you can sharpen your financial pencil. And these are applicable to anybody, you know, people in real estate, people outside of real estate. So if you have others that you think would benefit from this over time, either session by session or signing up for the forum as a whole, there's no cost to it, just a little bit of your time. And anyone who registers will get an email after each event with a recording of the session that we've done, so that if they can't attend live, you can still watch the sessions afterwards. So we're really excited to launch this. It's been something that has been a passion project for us to try to launch for the last 6 months. Happy to officially be doing it, and that all of you are joining us today for our very first session. So you could say I was there on the very first one. Today what we're going to be talking about is how to combat these higher interest rates that are all over the news. Seemingly every headline is about mortgage rates these days. And it is a problem. So we're going to talk about different tactics that people can use to try to offset that. We're going to talk about, first of all, what's happening with rates, both for myself, and I'll play a short video for you with one of the industry experts and their opinion, how those higher rates are manifesting in the market today, like what issues are we seeing related to them, a prediction on where rates are headed, both again for myself and other institutions and industry pros. And then what the actual tactics are that we can use collectively to overcome those issues. And again, if you have questions that come up, would love to have you guys post those in the chat so that we can make sure that we cover whatever questions you have. We'll post at the very end an opportunity to collaborate as well with all of our contact information. If you want to take those questions offline or get in deeper, then we can get on one of these sessions. By all means, don't hesitate to reach out. This is our goal, again, to raise the bar with financial literacy, and this is our first shot at it. So we appreciate you guys joining us. So I'm going to stop sharing my screen here. Okay. So first of all, want to give you guys a little bit of context as far as what is happening with interest rates. So as you probably know, interest rates were down near 3%, in some cases even lower than 3%. On a standard 30-year fixed loan, which we'll use as the benchmark for most of our conversation today. As of December 31st, we were at or under 3%, December 31st, 2021. As soon as January 1st hit, it seems like, or at least after the holiday ended, rates started to increase almost immediately. And we'll explain a little bit as to why. But now looking at today, which is, toward the end of October 2022, we are seeing rates backed by Fannie Mae and Freddie Mac that are now north of 7%, and sometimes even with points in order to get those rates, depending on the scenario. Jumbo rates are better than government-backed loans, but they're still in the 5s and maybe 6s, depending on the scenario as well. And we've seen inflation become a really, really big problem. So I want to play a short video for you from a gentleman named Barry Habib, who is a mortgage industry expert and an expert in mortgage-backed securities and inflation and other things that impact consumer mortgage rates. So I'm going to play you a short video. It'll last just about a minute. And then that will give you a little bit more context as to exactly what is going on. So bear with me 1 second, and I will play this video for you.
Understanding inflation, but we could see here the bottom line being the rate of inflation and this upper line being mortgage rate. Any kind of long-term bond, that's going to be driven by inflation. So when we see inflation go up, mortgage rates go up. Inflation comes down, mortgage rates come down, and so on. It didn't follow that pattern. It was broken with quantitative easing. Once the Fed fixed the game and rigged the game, they were buying enough mortgage-backed securities and treasuries to keep yields very low. And as you can see here, the Fed did a good job, whether you want to call it a good thing or not, but they did a good job of keeping mortgage rates roughly at 3% for the QE period. But meanwhile, inflation was moving up at a pretty significant pace. Normally, mortgage rates would have gone up, but the Fed rigged the system. Notice once they took the guardrails off and let the market behave freely, mortgage rates did what they always do, move with inflation. So as inflation went up, mortgage rates went up. Inflation dipped, mortgage rates dipped. Inflation up, mortgage rates up, and so on. So as you can see, we are in a situation where as inflation goes, so will mortgage rates go. Now, there are other factors, of course, but the main driver will be inflation.
Okay, so as you see, Barry Habib is, again, one of the mortgage industry experts who a lot of us turn to for advice and predictions on exactly what's going to happen. He's had a very successful track record of predicting how interest rates would move over time. So I wanted to share in his own words exactly what's happening. And basically, as a recap, what you saw is that as of January of this year, we started to see inflationary pressures start to grow. But the government at that point, where he's talking about qualitative easing, what he's referring to is that the government was purchasing bonds, and that inherently keeps interest rates low. Once they stopped doing that, then mortgage rates started to trace along with inflation and started to go up. And as we all know, inflation has gone up and up and up, and that's why interest rates have more than doubled in less than a year. So inflation has become a really big problem, not just in the mortgage industry, but everywhere. I mean, you're seeing it at the gas pump, you're seeing it in the grocery store. Everyone is getting squeezed financially. And the Fed is doing what they can with their set of tools to try to slow down the economy and slow down inflation, because at some point things become unaffordable. And if they slow things down too much, then what happens is it can push us into a recession, right? Which nobody wants to be in. And obviously we want people's income to be growing, which is still happening despite all these challenges. But the fact that everything is costing people more is affecting everyone in just about every purchasing capacity, and mortgages are really no different. Obviously, housing payments are usually the biggest expense for people. And we're seeing both rents rise significantly across the country. In some markets, 20% or more from last year. There's a huge shortage of housing right now, whether it be for rentals or purchases, which is having its own impact on the markets. And then with mortgage rates going up as well, that is actually partially driving higher rents, because if it's more expensive to buy, then there's more demand for rentals. And when there's more demand and less supply, that's usually when we see prices go up. So that explains why rents are also high. So renting is not going to give you much relief as opposed to purchasing, even though interest rates are much higher than they've been. So what's happening right now is you have buyers and sellers just generally not on the same page. They don't really know what to make of the current environment. They're not sure what's to come. That's partly why we're on this call today, is to try to help you understand what may be down the road and where the opportunities are. But we're seeing a lot of buyers, excuse me, sitting on the fence and just sort of paralyzed. Sellers not really wanting to lower their prices because they want the same price that their neighbor got, last year or higher. And there's a little bit of disconnect that we're noticing between buyers and sellers. What seems to be driving the buyer's side of that is the affordability piece, in part because inflation is everywhere. It's in everything that they go to buy. So if their housing expense comes in higher than what they're expecting, that's obviously a significant part of their monthly budget. So that is driving their ability to spend money on other things as well. And sellers not really knowing exactly what to make of this market either. If rates are double, should that affect rates? If so, how? I'm sorry, should that affect prices? If so, how much? And we're starting to see kind of a mixed bag of information and reporting coming out from the government and other industry publications and organizations about kind of mixed information. It's very much regional and sometimes state and even city specific, since there are different nuances to each city and state. But in general, what's happening is that transaction volume is slowing. So there's not as many transactions happening right now, partly because of this disconnect. What we're also seeing on the mortgage side is challenges with the secondary market. So secondary market means when loans are sold, maybe packaged and sold on the secondary market to other institutions that purchase them and then eventually handle what we call the servicing rights, which is all the customer service questions, collecting payments, sending out notices, dealing with escrow accounts, that type of thing. So right now, if you look at it, if you put yourself in a bank's shoes and a bank is looking at buying loans from another institution, the value of those loans when the rates have gone up so much and are potentially expected to drop, which we will get into, is significantly diminished. So they're not willing to pay as much for that loan as they would in a situation where they thought that that loan, let's say at 3%, was likely to be held for many, many years into the future, right? They're going to keep collecting interest on that loan for a long time. When you have rates up near 7%, and they went up sharply, in a lot of cases, when things go up quickly, they sometimes come down quickly. And they're under the assumption that most people are going to take advantage of the opportunity to refinance within a relatively short period of time as soon as those rates start to come down. So the value of purchasing that loan on the secondary market is diminished because they only feel like, well, I'm only going to hold this loan or this group of loans for a short window of time. It's just not as valuable to me to purchase it. So what's happening is that additional cost that makes it worthwhile for an institution to collect those is being passed on to the consumer. So agents who may be dealing with this, what you may see is some of your clients not even having an option to get a rate without points, or banks automatically quoting 2 to 3 points on a transaction, in part because they're trying to give you the impression that they have lower interest rates, but also kind of offset these higher rates. But the problem is you can't get, in some cases, especially on Fannie Mae backed loans, you can't so easily get rates without points because Fannie Mae isn't paying banks enough to purchase those loans to make it worthwhile after the bank pays, commissions to people like myself and other people in the industry and all the other costs associated with originating and closing that loan. So we're seeing a lot of loans get priced with points right now. And I wanted to explain that so you have some context to talk to your clients about, or if you are a buyer in the market, you might see that as well. Now that applies differently to different types of loans. Jumbo loans are kind of its own unique animal, so to speak. But conforming loans are kind of the loans backed by Fannie Mae and Freddie Mac typically are the benchmark for what's happening in the industry. And that issue is definitely persisting in that market. And especially if you get into second home and investment property loans where the pricing adjustments on those are pretty significant already, you're definitely not going to be getting options without points. So it's a little bit of a unique time, to say the least. So now the question becomes, okay, so rates have gone kind of sky high. I've been in the industry 20 years. This is as high as I've ever seen them. And so we're going, we're at roughly 25-year highs right now for mortgage rates. So there are, of course, no guarantees, but the question becomes what's going to happen from here? And I wanted to bring in my friend, Barry Habib here again. I'm going to share another short video. This one's even shorter than the last, but I wanted you to get a sense of the expectation on what's going to happen. Obviously nobody has a crystal ball, but this gentleman seems to have as close to it as you can get. So I'm going to share my screen here and play this short video.
We think there's a high probability that mortgage rates come back below 5% within the next 6 months. Maybe an outside chance by the end of this year, but because of those inflation readings, because we see a slowdown and we see the inflation comparisons start to become more and more favorable, you'll start to see that inflation number move lower, 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 lower. And as a result, mortgage rates should move similarly to on a downward trajectory, probably giving us around 5, below 5 within the next 6 months. And that change.
Okay, hopefully that share worked okay, but if not, you should be able to hear it. The prediction is that interest rates will fall near or below 5% within the next 6 months. We also saw a similar prediction come out from Fannie Mae, as reported by CNBC, and we're going to send everyone a copy or a link to that interview that we tried to share. I'm not sure that it actually shared. Sorry about that, but hopefully you could hear it. We'll send you a link to that, as well as an article that I was actually quoted in the New York Times about the topic that we're going to get into in just a minute, about the different tactics to use. And then also link to an article from CNBC that talks about Fannie Mae's prediction. And their prediction is that rates will probably settle somewhere in the 4.5 range sometime in 2023. So it's a little more vague than the one that you just saw. But obviously there are factors that no one can really predict. I mean, we didn't really anticipate a war in Ukraine and Russia. That's been ongoing, obviously, for a while, and currency problems and lots of different things happening right now in the industry that, or in the world, really, that are affecting mortgage rates and could change these predictions. And predictions are based on what information is available at any given time. So we'll see what happens, but any relief from these rates, up in the 7% range would be a huge help to be able to help buyers and sellers. So let's get into the meat and potatoes here. So the tactics that you can use as a buyer, a seller, an agent, or an advisor to be able to help people through this process. What we really have found is that the root of buyers' hesitancy has to do with affordability, right? They're not so concerned necessarily about the price itself. The price is sort of the item that they focus on, but it really happens to be more, in my opinion, based on what their monthly payments are going to be. So that can be something that could be overcome with some of these tactics. We also find that for people in our New York market that are on the call today, one of the issues has to do with co-op board approval. So if your payment is, $500 higher than it would have been 6 months ago, you may not qualify to get approved by the board. Similarly, if sellers have to drop prices significantly, some boards, even though they're probably not supposed to do this, might decline a transaction because they don't like a lower comp in the building. And so the idea is to try to find different tactics to be able to bring buyers and sellers together so that all of these different needs from different parties can be met as best as possible. So there's a handful of different tactics that we're going to talk about. So one is called a seller paid buy down. Buy down basically means that the seller is paying certain closing costs or points on behalf of the buyer. And there's two types to this. The first one is just what we call a standard buy down, which is where the seller pays points on behalf of the buyer. And the buyer uses those points to reduce the interest rate that they will pay over time. And the reason why this is an effective strategy is because the amount of money that a seller needs to credit to the buyer in order to reduce their payment is a lot less than what they would have to do if they drop the price in order to get the client to the same exact monthly payment. So I'm going to give you a couple of examples because this does work on both jumbo and non-jumbo loans. So let's start with $1 million loan to start. Let's say the seller is willing to pay 2 points, which is $20,000. So each point is 1% of the loan amount, $1 million loan. Each point costs $10,000. You're paying 2 points. So that's a total of $20,000. Okay. The buyer's monthly payment on that $1 million loan would go down about $425 per month. And if a seller were to try to reduce instead of paying those points on behalf of the buyer, if the seller were to reduce the purchase price of that home and try to get the buyer's monthly payment to an equivalent amount, they would have to drop that price by $75,000. So it's a matter of the seller contributing $20,000 as opposed to $75,000. It's almost 4 times more effective use of that seller's money to be able to buy points for the clients. If we look at a $500,000 loan, obviously the monthly savings is going to be less, but the same concept applies. So let's say in that case, the seller pays 2 points, which is $10,000 in this case. Buyer's monthly payment drops by $170 a month, and the price would have had to have dropped by $30,000 in order to achieve the same monthly payment for the buyer. So if you find situations where the buyer's monthly payment is really the root of their hesitancy, this can be a really effective tool. There is a second type of seller paid buy down that I wanted to talk about. It only really applies to government loans, which is loans backed by Fannie Mae, and higher cost areas. That's usually a maximum loan amount of somewhere around $950,000. That number may go up as we go into 2023, since prices overall have been higher. But let's use that number as an example. So the other type of buy down is something called a 2-to-1 buy down. So the way that this works is that you pay, the cost is based on a lot of different factors, but let's say it averages to somewhere around 2.5 points. So you're paying 2.5% of the loan amount. And what happens is, the reason they call it a 2-to-1 buy down is that in the very first year of the loan, the interest rate drops by 2%. So let's just say, for example, you're at a 7% loan, to keep the numbers simple. In year 1, your interest rate would be, and monthly payment would be calculated on an interest rate of 5%. In year 2, it goes up to 6%. In year 3 and beyond, it goes back to the start rate, which was the 7%. But in the event that we do see interest rates come down within 6 to, let's say, 18 months, which is my personal prediction, somewhere within that window, I think 6 might be a little tight. Maybe we'll start to see the decline, but I don't think we'll see the full value of it quite yet. It's not going to, rates aren't just going to drop off a cliff all of a sudden. I think it's going to slowly, like anything, all the charts that you saw in the video that I did share with you show, like, you know, the bell curve, so to speak. So you don't usually see rates just fall off a cliff all of a sudden on one day. So it will take time for that to fully materialize. But in the event that we see that happen, this basically means, let's say it's within the first year, that client is now paying 5% rather than 7%. Okay. And if we look at the actual numbers on a $500,000 loan in this example, the payment at 7% is $33.27. You don't have to write all these numbers down, don't worry. In year 1, the interest rate is at 5%. the monthly payment goes down by $643 a month. Now, for somebody taking a $500,000 loan, I can tell you from experience, that's a huge difference, a huge difference. And in year two, if the rate goes up to 6%, the difference is $329 a month. But if we see interest rates come down within that time frame, that means that the client may never pay that 7% interest rate. Maybe they'll only pay 5%, and that's a much more palatable number than 7%. So in order to achieve those same numbers with a price drop, as opposed to the seller paying for this 2-to-1 buy down, the price would have to drop, depending on which year you're looking at, anywhere between $50,000 and $100,000 drop. Now, again, for a $500,000 loan, you're figuring prices, maybe $700,000, $800,000, or, would be an average loan amount of $500,000, give or take. So you're talking about $100,000 difference, more than 10% of the purchase price that you'd have to lower the payment. And in the event that the client's comfortable with the fact that interest rates are likely to decline, and if not, they're welcome to look up Barry Habib, or call us and we can talk through it with them. This is a great option because it reduces their rate temporarily, but probably long enough for us to see the cycle come through where pretty much everyone who's taking a loan this year is likely to be refinancing. So it can be a really effective tool. That 2.5 points costs about $12,500. Compare that to a seller having to drop the price by $50,000 to $100,000. It's a no-brainer. Now, again, these are a little bit limited to government-backed loans, which are not the best rates right now. But if you're talking about going from 7 to 5 in year one, and then you refinance out of it, you're golden. And here's another little nugget that is great. The way that these work is that 2.5 points, and you won't necessarily see this in action, but the lender or the company that's servicing that loan basically creates a mini pool of funds that they slowly but surely take out every month to make up the difference between, let's say in year one, the 5% rate payment and the 7%. And what happens is if you refinance out of that loan before you've depleted that 2.5 points that they're holding on to and slowly but surely chipping in, you get a refund for the difference. So you might actually get money back from that, which may cover the cost of your refinancing. So it can be a really, really effective tool. One, especially again, on these lower loan amounts, you're not going to see this on a jumbo loan. Most jumbo lenders are not offering this. But it can be a great way to help, especially first-time buyers who are naturally very nervous and unsure and have a hard time making decisions. This can be a very, very effective tool and a much easier way for sellers to come in and offset that challenge of the higher rates. We went into detail on those, but there are a handful of additional things that clients can do. We are seeing a large increase in the number of people who are taking adjustable rate mortgages. Now, an adjustable rate mortgage, the term is misleading because the interest rate is actually fixed for the first several years, 5, 7, 10 years. And then the interest rate can start to adjust. So if anyone happens to refinance within, let's say, a 7-year period on a 7-year ARM, for example, then they're benefiting from a lower rate during that period of time that they're holding that loan up through the first 7 years. So if these predictions become reality over the next handful of years, let's say even it takes 3, 4, 5 years, the client is still better off taking an ARM product because they're going to have a lower rate in the meantime. And right now there is a fairly decent gap between fixed rates and ARM rates. So we're seeing a lot more popularity of these programs, which sounds scary to some because they're so used to hearing about, back from 2007, 2008, when the whole financial crisis happened and a lot of blame was put on those types of products, among others, but ARM products kind of got a bad rap. But in situations where they're used for the right reasons, which in my opinion now is one of those times where you can use it for the right reasons, it can be a really great way to lower your payment in the meantime while you're waiting for that refinance opportunity. There is a 3-year ARM product, but in my opinion, you're better off taking a 5 or 7 so that you have a little bit more cushion of time to wait for that rate adjustment to happen in the market. So ARM products is another great effective tool. Another one is buyers can pay their own points to drop their rates even further if they choose. They can do that along with a seller. Maybe they each share half the cost, but buyers always have the option to pay points. When you pay points, you're basically paying an upfront fee. 1 point, again, is 1% of the loan amount. You drop your interest rate by 1/4 to 0.5%, depending on the program and the options at any given time. And that also will help you lower your interest rate. That's a more permanent rate decrease as opposed to the 2-to-1 buy down, which really only applies to the first 2 years of the loan. But it can be another effective way. Again, if you're trying to get within a certain monthly budget and you want your payment to be no more than X amount, it can be a great way to bring the payment down incrementally to do that. Or if you're looking at co-op board approval and you need to get to a certain debt to income ratio, that's another effective way to do that as well. The other option, again, one that got kind of a bad rap, but serves a purpose, is interest only loans. So if people are really concerned about their out-of-pocket monthly payment, maybe they only want to pay interest for the first handful of years before that refinance opportunity materializes. An interest-only loan is always going to have the lowest payment compared to a principal and interest loan. It's somewhat artificial savings, so to speak, because you're really only dropping the payment because you're not required to pay principal, but you have the option to pay principal whenever you want. It's just not on a predetermined schedule for that first handful of years, which is usually anywhere between 5 and 10 years of interest only. So another way to potentially look at that. And lastly, you can combine several of these options that we've talked about. So for example, you could do it a 2-to-1 buy down on an ARM and pay your own points if you want to, right? And now you're talking about a really significant reduction in the monthly payment and the interest rate for that client. You're rolling back the clock, unfortunately only about 6 to 9 months, but you're making a really big dent in that higher interest rate that client might have otherwise gotten. So the goal here is to get creative and to find ways to be able to maximize the benefit for the client. This is something that we are experts in. We're having long and very detailed conversations with our clients to make sure that they're looking at the overall market, that they're not making decisions that are just based in fear, but ones that are educated and informed and ones that will benefit them in the long run. Obviously, there's risks associated with any approach you take, whether you go conservative and do a 30-year fix, which some clients, that's the right thing to do if they're risk averse. But we think that the ones that are willing to take a little bit of calculated risk on maybe an ARM product, maybe again combining it with the buy down, are the ones that are going to benefit the most. And looking at the overall market and just investing in general, whether it be in real estate or investments or anything else, the best time to buy is when other people are scared to buy, right? So right now we're seeing buyers getting a little scared. And so again, transaction volume is dropping a bit because of it. Granted, we're just coming out of summer, which in some markets are very much seasonal, but we're seeing in general a slowdown of transactions. So the question is, at what point will buyers be able to capitalize on that? Maybe a seller really needs to move out of state, or they have some circumstances that requires them to sell. Maybe it's not the ideal time, but they're willing to do it. And buyers can potentially come in, again, market driven based on each seller and each market, but buyers may be able to come in and get a better deal now than they could when rates were lower. So waiting to buy until interest rates go down is counterproductive, because if rates go down, we still have these inventory issues. Maybe they're eased a little bit, but still low inventory relative to demand for property. And so prices could potentially skyrocket back up if you wait. So if you're able to buy now, stomach the higher rates, maybe use some of these tactics in the meantime to keep your payments as low as possible, and then take advantage of that refi opportunity that we're pretty confident is going to be coming within the next 2 to 3 years. Those are the people who are going to benefit the most. And those are the people who are not being fearful about the market, but more being opportunistic. And those are the ones that will thank themselves for doing that in most cases. I mean, you look at, Warren Buffett and all these other people that love to talk about investing. And they all talk about when everyone else is running for the hills, that's when you want to go and buy. That's when investors in real estate make a ton of money. I do a lot of my own investing. Maybe some of you were involved in our 7-part series about about creating a side hustle in real estate, where I talked a lot about my own experience, which I'm very transparent about. I am gathering cash as we speak to try to acquire during this, what I think is short window of opportunity, to be able to buy properties at lower prices than you would have been able to buy, even though the cash flow might not be as good and the monthly payment might be higher. I think that's a temporary issue. So you buy at the lower price now, you refinance within a year, 2 years, even 5 years, but now you've gotten a lower entry point and eventually got your lower interest rate. So I think there is a unique opportunity. I think it's a relatively short window, because once interest rates start to drop, sellers are going to get a little more hesitant about price drops. And then there's going to be more demand for property, which is going to potentially push prices up. So anyway, I hope you guys have enjoyed this session today. Obviously, there's a lot to learn and a lot to navigate, especially for people that are not quite as comfortable and savvy with these topics as others may be. But I think what we found is that if people are willing to take that leap of faith and really take advantage of the opportunities as they're presented, that those are the ones that are going to benefit the most. So hopefully you guys have learned something new, and can take this to other people that you know. Agents can discuss these things with their clients and be better informed on exactly what to expect. But we feel there's tremendous opportunity right now, and we want our clients to understand that and to be able to take advantage of that situation and make the most of it. So I appreciate you guys coming today. We are doing our next session, which, as I mentioned, the Financial Wellness Forum is all about financial literacy. So not every topic is going to be about real estate. We are actually going to be pulling in a couple of financial advisors for our next session, because we feel like they are the quarterback of people's financial worlds, and should be, in addition to people like us that advise on more specific matters. But we want to bring light to the fact that there are different types of financial advisors. There are ones that may only charge based on fees, a retainer, or and then there's others that will want you to deposit $1 million or more with them. And there's different ones that can help people in different ways. So we kind of want to break down those barriers to help people understand, and bring in a couple of different advisors that operate on different capacities to be able to explain how that works. And so that next session is going to be November 16th. Hope you will join. Again, the predominant group that joined this call today is people in the real estate community. This forum is open to you and your clients. I think these topics apply to everyone. So if you have clients who may be interested in just sharpening their financial pencil a little bit, this can be a great thing for them to join. Again, there's no cost associated with it. We're just doing this because I just feel like it's necessary, and there's just a lot of lack of good information. And we want our clients to experience what we call a higher level of lending, but also just bringing important topics to people that we see people just aren't getting the right advice. So a financial advisor is definitely a quarterback of that process. And that's why we wanted to bring a couple in. And that's why our next session is going to be about that, again, November 16th. So anyone who's already registered for the forum will get an email notification about that to register for that session. And we'll continue to bring you guys great topics that are relevant to you. Anyone you know, you're welcome to invite anyone you want to this, and we hope to see you guys again. So if anyone wants to discuss any of this in more detail, would love to schedule a private consultation. Would love to see any questions. I don't see very many questions I don't see any questions in the chat. So maybe we've covered everything as well as we possibly could, but our contact information is here, and we hope to see you next time, and hope you have a great night.